we'll have a lot to discuss with our panelists, who I'm sure the rest will be joining soon. But I guess we'll start off with some introductions. So Emanuel, if you can introduce yourself and your firm.
Hello, Emanuel Timor, based in Tel Aviv. I'm one of the partners at Vertex Ventures, an Israeli early-stage VC. Most of our investments are at the seed or the A round. We're a generalist fund focusing mainly on the software side.
Perfect. So while we're waiting on the other speaker, I guess we can get started. So yeah, I guess Emanuel, from kind of your perspective, deal making has slowed significantly over the past 12 to 18 months. So what impact have you seen on early stage investments, and specifically new investments in early stage startups?
So I would kind of split the answer to two. Seed is much easier. Founders coming to us and our peers with new ideas. I think valuations have come down a bit. It's a bit, the process takes more time. It's more sane. There's time to talk, discuss, get to meet, and think about. But in general, I think let's go this it's working. Rounds are happening, and good teams with good ideas. It's never easy, but it's relatively. I think it's easier for them to raise money. As you go higher to higher rounds, it gets more complicated, because then it's an issue of what's the right price, what's the right expectations in terms of if the performance, the company, which is, I don't know, they did the seed, they're out there for a year and a half. What 2 years? What should we expect them? What's a good metrics for what they have now and for the focus for the next year, and what the right valuation? I mean, there you've got more of question marks, and then those rounds are taking longer. But again, I guess it's always that case. If you're a team that you've got the velocity, you've got the initial customers, you've got the ability to convince that the market is happening, it will be okay.
Mm-hmm. So it's kind of what VCs always say: the best companies will always get funded, no matter what the environment.
Indeed, Indeed, it is. I think that has always been the case, and it is true also now.
Perfect. Oh, well, welcome to our second panelist, Michael. So we thought we'd kick off with introductions. If you want to introduce yourself and your firm and give us a bit of an idea of kind of what your focus is.
Hi, everyone. Can you hear me well?
Yep.
Perfect. So we're Flashpoint VC. I'm one of the original two founders of Flashpoint VC. And we focus on Central Eastern European and Israeli founders and help them to build global software businesses. We do definitely everything from venture capital, which is Series A, to venture debt, which is mostly Series B and Series B, to direct secondaries, which is the strategy that I lead, which is mostly Series C and beyond.
Perfect. Well, you joined in the middle of a discussion about the impact on early stage investors with this shifting VC environment. So I guess it would be great to get your perspective on what impact you've seen on new investments in early stage startups.
Well, definitely, I think everyone has been aware that, there is a huge decline in investing in general, and this decline has hit Series A and Series B quite significantly. To me, actually, it's surprising, and mostly it's surprising because I feel that the risk profile for Series A has not really changed. It's improved, if you like, because if you think about it, I mean, the success of an early stage company is mostly driven by execution, less by market forces. So yes, there is a recession going on in the world. Yes, the Fed has raised, and the European Central Bank has raised interest rates. And as a result, economies are suffering. But crisis is always a good time to start businesses. Crisis is always a good time for new things to bloom and blossom. And at the end of the day, the success of these businesses is predicated on execution and the quality of the team, to a degree on the quality of the idea. But market forces start playing much more significantly sort of at later stages, at Series B, Series C, Series D, right? So to me, it's surprising to see this market trend. I think it's all about the availability of capital. So the problem is not on the side of the companies, so to speak, but on the side of the capital providers. It's the capital providers who have reacted to what's going on in the markets in this way. And, hopefully it will pass. Certainly we at Flashpoint have not decelerated. We think, crisis years are great vintage years for funds and are great for investing. So it's quite the opposite. You should be trying to invest and trying to buy when everyone else is sitting on the sidelines. It means that the quality of what you can access has improved.
Mm-hmm. Absolutely. Welcome to Dany Rammal. Thank you for joining us. I guess first off, would you like to introduce yourself, your firm, tell us a little bit about who you are and what you do?
Sure. Hi, everyone. Hi, Emanuel and Michael. Dany Rammal. I'm managing director at PSG Equity. I lead the European team at PSG. We are a growth equity firm based in the US and Europe that focuses on investing and scaling up software companies. So we come in at a slightly late stage, so typically 10, 20 million revenues, where we see an opportunity to scale up to 100 plus of revenues, with a combination of accelerating organic growth and doing M&A. So consolidation is a key thing in our playbook in terms of how we approach the scale-ups. We're about 250 people, of which 60 in Europe, the rest in the US. We've invested in 120 software platforms globally, of which 22 in Europe. And we have about 17 billion of assets under management. So that's really a quick introduction about PSG Equity and myself.
Great, thank you. Yes, so we're discussing the impact of the shifting VC environment on new investments in early stage startups. But how about your portfolio companies? How have they, kind of weathered the slowing deal-making environment?
Yeah, our portfolio companies are kind of generally tend to be with strong economics, often kind of break even or profitable. And so in the current environment, what we've seen is an increase in the number of add-on opportunities. So acquiring businesses that can be consolidated, where we see significant synergies in cross-selling with our existing portfolio. And so we've been pretty active actually on that acquisition trail and consolidation trail. And kind of it's a reflection of the lack of funding environment. So standalone businesses that may have a great product, great opportunity, but the go-to-market may be expensive to fund in the current environment. Well, some of our portfolio companies actually already have the established go-to-market and teams in place, and can help offer that in a synergistic way. And so we've been pretty active actually on that front through our portfolio companies in that consolidation path. And we think this environment is actually a good one to merge and consolidate as a way to address or mitigate the slow funding environment that we're seeing.
Absolutely. Emanuel, Michael, how are you seeing your portfolio companies kind of navigate this new normal?
Yes, it's tough for many of these companies, right? Because not everyone is in such a good condition that they have sort of funding available from the market. And even if they do, they might not like the price of this new funding that they can get for themselves. Our insight is that those guys who realize that the change in the environment is happening earlier, and those guys who have also adjusted their valuation expectations, and mainly who have managed to manage their costs and sort of decrease burn significantly earlier, those are the winners because they conserved cash, and cash is king in the current environment, right? So the more cash you end up with, the better off you are. You can fundraise later, you have options, even potentially, you're in a better position to merge or consolidate maybe some of the other smaller players who are struggling because of the extra cash that you have. So we have been pushing actually quite hard our companies back in middle 22 and third quarter 22 in order to conserve cash and save costs. And many listened, not all of them. Interestingly, some of those who didn't listen now say, oh, we should have listened, which is still a good response in the sense that, even if you didn't cut costs back then, if you can do it today, our recommendation is still the same. Do it, conserve cash, because it's not like the market is already turning.
Absolutely.
I think the issue is all of our companies are trying to be more to make sure the cash lasts longer and that they burn less. Part of it has to do with the fact that from the macro side, the demand to the product they are selling has slowed down. Now, luckily, there's no yet recession for tech product, but everything. I mean, we feared at the beginning of the year there'll be a recession. Looks like, at least for now, there's no real recession, but there is a slowdown. There is everyone purchasing processes are taking longer. Price pressure is higher. So in general, a company, the same company that 2 years ago and today, even if it's still a good company, everything is fine, is growing slower, and you need to adjust yourself to it. I mean, so there are two pressures. One, valuations have come down. And second, you're growing, most companies are growing slower. They are growing, but they're growing slower, which is another effect on your valuation. So I think that our companies in general, and we have companies starting from the seed all the way, I mean, we are growing with them. So some of them are at the post $100 million ARR. So everyone are trying to be more conservative on the cash, looking in it for opportunities to grow unorganic through acquisition. Everyone thinks that soon they'll be able to buy other companies at a low price. I mean, we are good, but they'll be willing to sell themselves for a low price, right? So as usual, we see our portfolio is great, others are suffering. So we need to see how this plays out. But in general, yeah, everyone are trying to be more conservative. Everyone needs to, in a way, grow into the valuation, right? They raise money in the prices and valuations and multiples of 21. And now we're in 23 and 24. Valuations multiples are, let's say, around half. So you need to adjust yourself to it. But all in all, compared to our fears when we entered 23, things look better in the sense that the demand to software solution, mainly software, B2B and infrastructure, is better than what we feared it would be.
Mm-hmm. Absolutely. So obviously, you mentioned conserving cash, extending, startups runway has been kind of a priority for investors over the past 12 months, which, kind of brings up the question of growth versus profitability. Obviously, a lot of investors are now kind of asking their startups to focus more on profitability, but in the early stages, how easy is that? Because you still need that growth as a seed stage company or a Series A. So how do you kind of reconcile this need for profitability and growth in this market?
I don't think profitability is relevant to early stage. I mean, if you're A or even B, you don't need to be profitable. I mean, if you'll be profitable, you're never going to be the large company that we are investing for. We are investing with the hope and belief that the team and the product and the market are big enough to create a huge company, a game-changing company. You can't do it while reaching profitability. What we do want to see is healthy growth. That you're building the pipeline. That we can see how can it scale. That the efficiency in generating the pipeline all the way from the leads to the sales is healthy. And if that's the case, then we are fine. And if this is not the case, then we have an issue, and we need to understand: is it the product or is it our go-to-market?
Mm-hmm.
I would agree with Emanuel. It's a tricky question because we've seen some of our companies cut costs significantly, and at the same time increase growth. And the founders were befuddled. They were like, what's going on? And the reason is that they actually cut out some of the red tape and some of the inefficiency. They had too many people. They were unfocused, right? And instead, by downsizing, by basically getting rid of 25% of the worst performing employees, they actually refocused themselves to the task at hand. So we had a number of companies in our portfolio which went through this very interesting phase of basically decreasing cost and increasing growth at the same time. So to me, the spend and the growth is not linearly related. And what's important that in times of crisis, you just have to be incredibly focused as a management team on the task at hand. And definitely in the early stage, we're still focused on growth and not on profitability. But, it needs to be efficient growth.
And to add to Michael and Emanuel, it's all about the unit economics, right? It's not about growth and profitability. It's more about the growth at what unit economics, and does it make sense or not? It's CAC and LTV ultimately and payback. And if that makes sense, then keep going. And if not, then you need to revisit the structural cost base to address the unit economic weakness, or see if it's a product or a go-to-market issue.
Yeah. So looking at the early stage market and more at the investors rather than the startups, have you seen investors' strategies or priorities change in the last 12 months? Have you yourselves changed your strategies to kind of, go with this new market?
I can start. I mean, we haven't seen. I think that the market is not broken, but it's on kind of freeze or standstill, because no one knows how to price companies which are later stage, and this goes back to the early stage, and no one knows what's the right, or we have our estimation, but the right pricing has not happened yet. So I think many investors are on the fence waiting for the right opportunities to come. I mean, you've got the companies you like, and you know what's the valuation you hope to invest in them, and now you're kind of starting to meet and see if that can happen. And we hear and are involved either in down rounds or companies that are raising at valuation which are much lower than what they were hoping for in the past. So I think that the main strategy is slowing down with understanding, hope that prices will, two things, prices will go down and companies will grow up, and it will be easier to justify the price they want.
What Emanuel mentioned actually is one of the other reasons potentially why the market has slowed down at the early stage, right? Because sort of funds have adjusted their valuation expectations almost instantaneously as the Fed rates have went up and the public markets have gone down in terms of the valuation multiples. Whereas for founders, entrepreneurs, owners of businesses in the private markets, it takes time to adjust valuation expectations. So Emanuel is absolutely right that, often sort of we see great companies, we would like to invest, we're pricing them as we think in line with what today's environment is. But these guys are still in the old days of what they were worth 6 months ago. And it's very hard for them to adjust. They almost need to go through the 7 stages of grief to understand that their business is now worth half of what it was worth 6 months ago. And it's not an easy process. In terms of sort of how we adjusted our strategy, we do think that it's a great time, but we think that you need to support people who are realistic about the environment, right? So if people are unrealistic, it's not great because you need to be realistic in order to build good business. So we've just put this price discovery earlier in the process, right? Before we were more focused in understanding the quality of the business. That was the key sort of step in the beginning of the process of learning about a new company. And only then you would come for price. Whereas now, almost the first question that you want to ask is, what do you think about yourselves in terms of price? And if their expectation is clearly unrealistic, then, well, there is no sense even in doing the work in terms of understanding whether they're good or not, right? So sort of the way how you structure the investment process has had to change. Another interesting thought is that obviously there has been sort of this disruption coming sort of from ChatGPT and AI. So definitely at Flashpoint, we have started thinking, okay, AI is one trend, but in terms of like the sectors which will be the winners in the next cycle. So there is a huge economic cycle coming again, right? And we are sort of at the moment when we're sort of in the early innings in this cycle. We're still in the crisis from the previous cycle. Who are going to be these sort of big drivers of this new cycle? What is going to be the big fundamental change in the economy? And which are the sectors that will sort of benefit from this change? And then you want to focus on these sectors. So we have also thought sort of in a top-down way about where we want to position ourselves in the next phase.
Mm-hmm. Yeah, absolutely. I mean, we've talked a lot about valuations, and obviously investors having to re-evaluate the valuations of their portfolio companies and how founders have kind of reacted to that. But what about limited partners? When you have a portfolio of companies and you need to, reevaluate what they're worth, how do you broach that conversation with LPs? Because obviously they were expecting, these higher valuations within that portfolio. I guess we'll start with Dany. How do you kind of talk to LPs about kind of managing expectations?
I think this is key with LPs. It's all about communication as frequently as possible, and that's probably the best practice or advice that we can give to people is, LPs understand the environment, they understand that valuations have come down, and then it all depends on the portfolio and what prices you paid and what the growth of your business is, and is your growth compensating for the decline in multiples? And, people understand that. Everyone is rational. LPs are very sophisticated, diversified. And so it's really all about communication and giving the data. And so that's really what we've been doing. Again, we're coming at it from a very different angle, versus the earlier stage where valuations have indeed reset substantially. At our end of the market, the multiples changes haven't been as dramatic, and so certainly the growth has more than compensated for that. But still, LPs are asking all the right questions, and so the best way is to communicate and on a regular basis.
Mm-hmm. I mean, what are LPs looking for now in kind of their GPs in terms of the early stages? If either Emanuel or Michael, you have any insight into that one?
I don't. I mean, LPs invest for returns, and it's a combination of multiples and IRR. In my mind, multiple is more important, but and nothing has changed in that. And yeah, we had a run which had a combination of DPI and TVPI, and I think one thing that LPs now are looking at their investment and are asking, okay, we had great years where valuations, the value in the books was growing very fast, very high, much faster than, let's say, the last 7 years compared to the previous ones. So that's great, but how much of this was on paper and how much of it is actual cash DPI that came back, and what can we learn from this about GPs and their portfolio? And I think it's the regular kind of analysis of, let's look at the portfolio, let's look at how healthy it is, how much of it was driven from companies where kind of were part of the hype or had real businesses, had and have real businesses. So I think, as always, we're in a business of looking for the outliers and the best of the companies. So I think it's the same analysis. How much of your portfolio and how much work have you done with your portfolio that follows those targets and those goals.
I would agree with Emanuel that their analysis hasn't changed. Maybe what has changed is, their perspective on risk return, because obviously, they usually hold a large portfolio, and we are sort of maybe 2%, I don't know, 3% as alternative investments, sort of very liquid investments, right? We're on this end of the spectrum as early stage VC managers in their total portfolio. And given what has happened with the markets in general and the other opportunities that are out there, I think sort of LPs have at the moment less appetite for illiquid things, because in the moment when rates are rising and markets are tightening, they also, similar to businesses, are trying to conserve cash, right? So even though there are no changes on our side, and sort of the way they should be thinking about it is the same, but they are all living in the marketplace, and they're affected by these changes that are happening in the marketplace. So they're trying to conserve cash. They're trying to understand how the market is going to pan out. When is the environment of raising interest rates, when will it stop? When will this trend sort of reverse itself? And so I think it has become harder for GPs, for managers like us, especially at the early stage end of the spectrum, to raise. And only the most high quality managers still have an opportunity to raise money, which is, again, sort of counterintuitive in a way, because as we know, crisis years are the best vintage years, right? So you would think that having looked at the history of the last 50 years, the LPs would recognize that now is the time to give us money, actually. If you give us money now, we'll probably hit it out of the park. But it's not happening, unfortunately.
And ultimately, it's really a liquidity issue, right? And so effectively, that's why the biggest change in the communication with LPs, and the most common question is, what can you exit when? I mean, what's the, going back to your point, Emanuel, about DPI, it's how can you give me some returns back? Because everyone needs the liquidity, and also everyone wants to de-risk. And valuations may have come down on the books, but they're still up on what was invested. And so realizations and giving cash back to LPs is critical. And I think the GPs that will be giving money back to their LPs in these times of crisis will probably come out stronger on the other end of this.
Yes, on a more...
We were not in an equilibrium, in the sense that there was too much money in the system in 21 and also 22, and we were at the end of it. Kind of that dry power is so that we're discussing is the end of it. But so to have a healthy environment, as Michael said, I mean, that's the best time to invest because valuation is coming down, and we've got Gen AI and LLM, which generate a new great opportunity. At the same time, you want the funds or the ecosystem as a whole to be smaller in terms of how much money is in the system, because again, there was too much money. So the only question is, let's not move from too much to too little, and in the middle, it's very hard to do it. It's like a prisoner's dilemma. I want to invest, but some of the others not to invest. And obviously we cannot control it. So that's why we've got the bust and dust. So we had too much money. And now the question is, as an ecosystem, we'll have the right amount, too much or too little? I think it's still unclear.
Mm-hmm. Absolutely. I mean, speaking of opportunities, kind of looking forward over the next year, deal making is slowing down, valuations have gone down, but there are still some really good opportunities for investment in this market. As you've said, Michael, these are kind of the best vintages of, times of crisis. So what are for you the main opportunities that you're seeing in the market at the moment? Let's start with you, Michael.
Yes, thank you. I mean, it's interesting, but one of the opportunities that we saw last year was travel, and in general, I would call it sort of COVID recovery. So we felt that there were a number of industries which have been severely hit by what went down in sort of 2021, 22, and then that has been even maybe exasperated by, the markets also going in the wrong direction. But we felt that people are going to want to travel, and there is going to be a huge renaissance in these sectors. So we have focused quite hard in the past 12 months on these sectors. Another interesting trend that we've been following is sort of the change of habits, and this is also partially sort of a COVID disruption related to how people work. So, back in the old days, pre-COVID, most people would go to an office, would go to a workplace 5 days a week, right? That's not the norm anymore. And this means that it's sort of a significant change in our habits of how we do knowledge production type work. But it also has significant implications for the real estate market, for example, for property technologies, right? So flexible offices are now the norm. And there's a lot of things and innovation happening around making these new work habits sort of work. And then the third big revolution at which we're looking, and I think everyone is looking, is AI. It's a hard one to figure out. There is sort of a lot of deep tech in it, in some sense, and hard to predict which technologies will succeed and which business models will win. But it's definitely very interesting, and is going to be one of the big drivers of the next revolution, or the next sort of shift in the web.
Mm-hmm. Yeah, Dany, what opportunities are you currently seeing in the market?
Yeah, look, for us, our view is actually the underlying opportunity for software and technology adoption in businesses is tremendous. It's big, and we're still kind of going through that adoption curve, and we're in the early stages of it, especially if you look at Europe, and we compare it to the US. Europe is still quite far behind on that adoption curve. So there's still whatever sector, any vertical, and we often get the question from LPs, so what are you currently focused on in terms of verticals? And the answer is actually this adoption curve is strong, and there's still way more ahead in terms of potential for adoption of these solutions, whatever the vertical, whatever the sector. So we see a lot of opportunities. Geographically, clearly, Europe has a big gap versus the US, and so broadly speaking, that's where we are focused and quite excited by what we're seeing. And so we of course, some sectors, maybe as Michael pointed out, agree, travel, cybersecurity, digital document management, AI, of course, a lot of the stuff that is going on at a faster pace than maybe verticalized SaaS. But across verticalized SaaS, which is huge because across all sectors, every function is digitizing, we still see a lot of white space.
Yeah, I do want to touch on generative AI just briefly. I feel like every panel has to include one question about generative AI at the moment. Just briefly, generative AI, overhyped or not overhyped, Emanuel?
Not overhyped, very, very interesting. I think it has the potential to be the next wave. It is evolving much faster than previous, let's say, mobile, iOS, cloud, let's call it revolutions or kind of changing moments. It's happening so much, and there's so much money out there, and the big guys are there from the start, that how do you utilize it from new startups point of view? That's kind of the big question. I mean, it's clear that every company will utilize it. How do we generate this into new opportunities at the infrastructure level, at the management level, at the new verticals which will disrupt? I mean, that's a big question of how to tackle it, but the opportunity is there, and I think we'll continue to hear about it in the next few years. It looks like it has amazing potential.
I can only second what Emanuel said, but also as a father of 3, I'm a bit scared, I have to admit. I think that it's the first time that as a venture capitalist, I look at sort of the landscape, and I also have some regrets. We're here trying to make money on these wonderful new technologies, but for the first time, at least intellectually, it seems that the threat of something going wrong is also real. but hey, we still have to do our work. So, we have to push on with that.
But tangibly, and maybe short term, in terms of direct impact, the way we look at it or encourage our portfolio companies and founders to look at it is, it's two different things. There's how does it affect your product and your solution and what you're offering to your customers, and is there something that you can improve, that you can offer more, that can make your solution more relevant? And that's really one path. It's probably the harder one to figure out today. And there's the second one, which is, I think, should be more immediate for everyone to look at and say, how does AI help me generate or run my business more efficiently? How do I run my processes? How do I run my R&D more efficiently, and maybe reduce the number of people that do this, or at least have them do more because of automation? And so it's really two different perspectives that we encourage our founders and CEOs to consider when they're thinking about AI. And it's easier to make progress with how to run your business more efficiently with automation. We can see more direct, easy to implement use cases there than actually how do you really evolve your product and your solution, which takes more time.
Most of the companies out there already sort of have like an AI strategy, and this was not the case 12, 24 months ago. It was just a buzzword, and often there wasn't anything behind it. But now all of our successful companies which have moved on to Series B, C, D, as Dany said, they are like thinking, they have sort of a group of people who are thinking, okay, how do we optimize our business processes using AI right now? And they're already implementing certain sort of quick wins that they have found. And this is amazing because it means that there is going to be a huge leap in sort of general productivity and efficiency as a result of this revolution. And this will happen very fast. I agree with Emanuel that sort of the pace of change is maybe much faster than in the previous technological revolutions.
Yeah. I want to touch on consolidation before we move on to some questions, if there are any. So, Dany, is there a certain profile or type of company that you think is more of a target for consolidation than others?
Not necessarily. I think it's for sure if you're, single product, single country business, subscale in the sense that, sub 10 million of ARR and unit economics are not very strong. That's an obvious target for consolidation, right? And finding the right home to continue is probably would be the smart thing to do. And so other than that, the way we think about consolidation is there are a couple of ways we think about it. One is, product adjacencies. So effectively, can we bundle 2, 3, 4 products and sell them to the same end customers? And so we become, as a business, more relevant, more sticky, more critical, instead of just selling one solution. And that's generally the most value accretive type of consolidation play. And the second, and it's obviously less accretive directly or in short to medium term, but it's the geographic expansion, and where you're effectively expanding your addressable market and over time generating synergies from that expansion and increasing the odds of being a self-funded, growing, profitable business with a bigger TAM. And so really these are the two type of ways we look at it, but clearly product adjacencies is really the most immediate way to consider for consolidation.
Mm-hmm. Looking forward to for the rest of the year, do we expect consolidation to accelerate?
I can go and we're certainly seeing a lot of opportunities relative to last year, and the beginning of the year we've closed a number of deals on or acquisitions for our platforms well ahead of what we've done last year. So I think that trend is happening. At least we're seeing it, and we think it'll continue for a while. It makes sense to consolidate in software.
I see. Well, if we have any audience questions, I think now will be a good time to see any. So Series A companies still have 3 to 5 years before exit on average. Do you have confidence in the market scenario that the market scenario will improve by then? And that's for Emanuel.
I agree, and I would even say that to take it all the way to be a really large company selling for $100, $200 million ARR, $500 million ARR, it's not 3 to 5, it's even 7 to 10. So obviously we are optimistic. As Dany said earlier, the market, we are the need for technology, the need for software in every market, any aspect of our life is there and is growing. So we are optimistic about tech, and that's why we continue to invest in the seed and A and continue to support other company in later stage, and we are bullish on the industry. So yes, I agree that the market is there and the opportunity is there, and that's why people are saying a crisis is a good time to invest. The market is there, the demand is there, competition has slowed down. The cost of doing business is slower, right? From renting or expenses, except for flights, which has gone way through the roof, and the competition on talent is a bit easier. So yeah, I mean, it's all start from the fact that the demand for what we do, software solution or technology and deep technology, is there, and that's not going to go away.
Great. Next question. So technically, the panel says the early stage startup must have positive revenue. It is no longer pre-revenue. So pre-revenue only works for founders who most likely have a successful exit or investment connections. Can one of you shed some light on this perceived reality?
Yes, it's a tough one. Actually, we at Flashpoint, we don't do pre-revenue businesses, right? So we've always focused only on businesses that already have revenue, because pre-revenue is just a different type of risk. Our understanding is that definitely if you're in the pre-revenue segment, the more sort of success you have had in your previous careers, the earlier it is to fundraise. So even we at Flashpoint, even though we don't normally do pre-revenue businesses, we have given money to the same entrepreneurs a second, a third time, right? So people with whom we had big success, good exits, if they then go with the money and sort of start building their new venture, we're very likely to support them because we know these people, we know what they're capable of, and we think it's good business to be with them again. But it is tough, and I think that as we discussed, I mean, it seems that the early stage has been squeezed more than the late stage. And to me, the early stage, which is the pre-revenue, right, the pre-seed, that's where the squeeze has intensified even more. So if founders can start businesses by using their own capital, basically building up, or maybe finding a way, still completing their work and, getting to revenue, doing this project sort of as a second business in the evenings. I do recommend that for people, because I think that the further you manage to push it along yourself, the easier it becomes to fundraise, the more you have sort of to show to the market.
I have a different perspective on this. We as Vertex do seed and A. Seed is founders coming to us just with ideas, slides, and about half of our investments are there. So, and I think if I look at the scene in Israel, teams that come with great ideas at the inception stage, good teams, good, in most cases, first timers, no founder entrepreneurial experience, will get funded if they have the right team targeting the right market, and so it's not easy to convince, but it's happening, and actually the seed is performing better. Seed and very early stage is performing relatively good, and and in a way better than the later stages. Most of those companies would be some kind of a technology. They would have, in most cases, also a technology capability, and part of the moat would come from not only technology, but it's why the market is interesting and why we have something unique and can take that market. But I don't think that the fact that you're a first timer is a disadvantage. Some of the best companies out there were founded by in a way, the best companies out there were founded by first timers. So and again, most of what we do is invest in first timers.
I think Israel, though, is quite unique. It's a little bit of an outlier if you think about sort of, the larger CE region. I think, unfortunately, the situation is worse. There is a lot of history in Israel, and, it's like a second Silicon Valley. So, but I think you're right. Israel is in a much better spot than sort of the rest of the countries in Europe.
Great. We have another question. So have you seen activity on the secondary increasing or decreasing in the past year?
Happy to start. As a manager of a direct secondary fund, this is exactly what I do day in, day out. Yes, definitely there is a huge increase in supply of secondaries, right? So this overall push for liquidity has also materialized here. So it's not just the LPs that want to get their money back. It's not just the businesses which want to conserve cash, but it's also people who have their sort of money tied up in well-performing companies or just companies. Many of them are now looking for ways to generate liquidity from these illiquid positions. And what usually happens is that when supply increases, prices go down. Right, so definitely we have seen a significant compression in prices. So if back in 21, we have seen secondaries which were done at the same valuation as the primary rounds, done around sort of the same time, and often secondaries would get snatched up in a matter of weeks. Today, we're in a market where we see secondaries that are outstanding for 6 months, 9 months, and still there is no buyer. And we see the price going on a curve from, being a 30% discount to being a 50% discount, and then sometimes even deeper. So definitely much more supply. I think it's a very interesting market. It's very illiquid, very opaque. And, an opaque market creates opportunities. But in terms of the demand, I think that the demand has also decreased because what we've seen in 21, that a lot of the primary funds have been using their capacity and funds that were sort of earmarked to do primary also to scoop up secondary, right? People were trying to grab as much as they can. And now they completely stopped doing this. So there's more supply, there's less demand. So, you can guess where the market is going.
Great. Well, for the last couple of minutes of the panel, I want to ask each of you, this time next year, do you think the VC market for early stage businesses will look better or worse than it does now? Let's start with Dany.
It's a difficult one to predict. I think that the VC market, it's structural part of the ecosystem, given the demand for tech and automation, and that's an underlying, strong tailwinds are there. They will be there next year. Things aren't going to slow down, and so then it's just a question of liquidity and supply and demand of liquidity, and how does that get allocated between the early stage, the later stage, and the public markets, and ultimately depends on what the LP's portfolios are. I think overall it looks like we're getting back to an environment where public valuations are better and there is substantial acceleration of the tailwinds with the AI and a lot of funding going into it, and ultimately that will trickle down to better productivity, and that will also continue to fuel improvements in the sector and in the valuations in the sector. So I'm generally optimistic, obviously, but we'll see. It'll be interesting to see where we are in a year from now.
I think, assuming no macro is a bad surprise, we'll be in a better position. But we can divide it to two: new investment, new money looking to new investment. Will continue to be a great time to invest. And the correction for the historic portfolio, the current portfolio, that will continue, and there we'll see the continuation of best companies fundraise, and the one that need to adjust the valuation will need to do down round or sell themselves. So in general, I'm very optimistic, especially for new investments, but also for the companies in the portfolio that are doing well. For them, I think that's going to be a great period, because the fact that people stopped investing while funds are raising money means that a lot of investors who are on the fence will get off the fence and back to the field in let's say 9 months.
Mm-hmm. Yeah.
I'm also optimistic, and the reasons are to a degree similar to what Dany and Emanuel have quoted. I mean, the first reason is simple, really. All these interest rate rises, which we have seen in the past sort of 18 months. I mean, now the interest rates are very high. So it's very hard to see the rates going up again and again and again for the next 18 months. Maybe there's one more hike, maybe there's 2 more hikes, but we're definitely closer to the end of this period of raising interest rates than we were 18 months ago. And as soon as the rates stop rising and at least stabilize, we will all know what the environment that we are in. And stability is what ultimately makes for good business, right? We need stability. We need a predictable outlook of how the economy is going to look 12, 18, 24 months from today. And then that comes down, sort of trickles back to us, because what I would like to happen is I would like the founders, the entrepreneurs with whom we're working day to day, to sort of fix their expectations on what the valuations are, right? They have been quite fixed back in 2020, 2021, 2019, when, things were going great. They will now also fix, but at a different level, not where they were back in 19. But it will become, again, a stable environment where people will know what their business is worth today, in today's world, and they will accept it as the reality that is going to be here for the foreseeable future. And as soon as that happens, when both sides think the same way about valuations, it's going to be great for business again. It will be easy to do deals.
Absolutely. Well, thank you so much to my panelists for their very interesting insights, and we'll hand it back.